So today, again, I just wanted to look over the indices just to see where we're at generally with the markets. As you guys have known, if you've been kind of keeping up with the notifications and current market statuses that I've been putting up in the feed of Patreon, you know that since I guess around, I think it's mid-January, the markets took quite a sharp dive, quite a sharp dip. And as such, you know, we haven't been able to really do any activity on the markets. As you know, we're trend traders. And as trend traders, we go with the trend. So there's two different things, right? There's the trend and there's the bias, right? So the overall trend is bullish. And it's been bullish for quite a long time. But the bias has actually in recent, in the recent weeks, has been quite bearish. So if those two things don't align, then we're unable to trade as we are trend traders, right? So, I mean, if you've been looking at the charts or anything like that, you would be aware that, you know, because the bias has been down, it's been quite, there hasn't been opportunities for us to, you know, trade. And at best, what we've been able to do over the past recent weeks is actually manage our trades. Because what will happen is, you know, if you were in any trades, excuse me, if you were in any trades at the time that it started to go out of a bearish bias, you know, you have a decision to make. Let me ask the chat, what are the two things you can do? Say, for instance, you're in a bullish trade and then the market or the buyer starts to go a bit bearish. What are the two options you have to do if you're already in the trade? And when I say go bearish, I don't mean like a slight bearish candle. I mean like quite a deep bearish dip, if you would like to say it that way, that we've experienced over recent times. What are the two options that you can do in those situations? Okay. So Daniel Bolton says review the stop loss. And Neil says close your trade or ride it out. Both of those are kind of the correct answer, right? So the two things you can do if you're already in a trade and the market starts to go, you start to see signs of strong bearishness. So let's go with Neil's first. So that's exactly right what you can do. Like for instance, if you, all right, now let's just do it this way. Let's go with Daniel's answer first. So Daniel says review the stop loss, which is correct. You would review it. And by review it, I assume you mean like, you know, adjust it. Because obviously when we place our trade, we already set a certain limit. We set a certain level at what it is, right? So we don't really need to review it as such, but we do have the option to move it, right? So if we know that we're going through a brief bit of volatility, you know, we can, if we believe that the market is going to continue going up, you can give your stop loss a little bit more of a wider berth, right? And this is if we have some expected volatility going on. We might want to move the stop loss a little bit wider in order for price to, you know, go through its increased volatility, it throws its hissy fit, and then eventually it will stable up and continue to the direction that we kind of assume it will continue to go on in the future. The issue with that could be, how far do you move your stop loss, right? So let me bring up this chart that we have here. Let's bring up the daily chart. Let me see. I'll make sure I've got my right indicators on. Yeah, I think I do. All right. So let's say our current, you know, support level is around here, right? We can see that, you know, since price broke it here on the, so the price level is 155,557.60, right? So, and this is the index, right? This is not an individual stock, but we're just using this as an example, right? So we can see that price broke and closed above this level on the 26th of October 2021. And then we can see it rose, it pulled back, it rose again to our, you know, current high level. If we put it here, we can see we're in a bit of a consolidation channel, right? So price reached this high level around this 16614.87 level. It did break it slightly higher in this instance here, but we can see it went up to that level, it came back down, pull back down again to this 155,557 level, 15557 level. It kind of pulled back again and then retested that same level. So you can see 2 points here and here that this level has held as a level of support, right? So it's almost like a double bottom. Let me draw it here, but the middle is a bit messy. Ideally for a double bottom, we'd like to see something cleaner going straight up and coming back down, but it's not too bad. It's not too far off a double bottom. You know, I guess you could call it kind of a double bottom. The middle is a bit, it's not really sharp, but you know, it kind of does follow those lines. And then we can see the raising up here again. So we can see coming from our resistance level all the way back down to our support level. It's pulled back up again, down to our support level once more, and then back up to our resistance level. So we have a double bottom here. So a double bottom is essentially, you know, price retesting our support level. It held once, it pulled back, it tried to go again, and it didn't work. So when it didn't work, it came back up again for the second time at our resistance level at our 16614 level, right? So you can see prices, this is showing a bit of indecision. It doesn't want to go higher and it doesn't want to go lower. So it's kind of testing both of them, highs and lows, right? So it came back down again to, on the 7th of January, it came back down to our support level and didn't break the first time, but the second time it broke through slightly, but that was a fake out to the downside, right? So it pulled back up, and then on the second time of asking that's when it actually went through our support level and went to the downside, right? So if we go back in time, we get in a DeLorean, we get on our Mighty McFly. If we take it from, let's say, this bar here, right? If we were to say that, you know, this is our expected resistance level, our support and resistance level, we can see here it acts as a bit of a resistance level. So it has precedent at this number. If we go back a bit, okay, this is the highest we've reached. So we can see at this level here, it's got some precedent of a resistance level. And then when it broke through, it became a support level. So it showed an effect on price a few times, once, twice, 3 times, and 4 times, if you want to count this candlestick here, this bar here. So yeah, so we can see the first time it tried to break through the resistance level, it didn't manage to do so. It pulled back again. And then on the second time, we got the similar thing. So if you look at the bar from the 10th of January and the bar from the 14th of January, they're very similar, right? So the first time we saw it was a fake out and it pulled back. Now, if we'd have seen this second bar, we could have seen it being the same as this bar. Obviously, the wick is longer here. So actually, this bar is actually a better bar than this bar here on the 7th, right? Because this bar on the 7th, throughout the day, went to a lower level. It went to 15176.99, right? So this is a worse looking bar than this bar, although the body is similar. So it means it basically entered and exited at the close of the market, this around the same area as this day on the 14th, right? So if you was at the 14th, you could be forgiven for thinking that, we're going to get a replication of what happened here on the 10th, right? It's actually an even stronger indication because we don't have this long wick to indicate that price did go lower. It stayed at a similar level. So, you'd be inclined to think that we'd have a replication maybe of this second bar on the 11th of January. So maybe we would have, after the 14th, we would have a bar that kind of come back up to here, this similar level, and we'd see a bounce off and come back. I mean, if you think about it, price has been doing that for a while, right? It's been going up, coming back down, going up, coming back down, going up, here, coming back down. So you would not be, too far off thinking that after it bounced, it would then continue to go back up, right? So we have this level on the 14th. So we could be expecting it to go back up, right? But then we see an actual red bar, right? So this is, counter to what we would probably, predict or expect. But at the same time, look at the level of where this red bar ends, and then look at the level of the candlestick on the 10th of January. They're both at the same level, right? So it's establishing something here, right? So if we're establishing maybe, some kind of maybe secondary support level at this level here, you could be, you could in your mind say, okay, it's had a history of getting stuck in this channel between this support and resistance level. And although it's broken down before, it has actually pulled back. Now we've seen a similar candle and we didn't see an immediate pullback. However, price did go down only to the level of this previous wick in which it did pull back at that time, right? So, as Daniel said, review the stop loss. One form of action you could take would just be saying, well, let's say for instance, this red line was our stop loss and it was like, say for instance, somewhere like here. So we didn't quite touch it, but we came close to it, right? We could say, yeah, let's give it a little bit of breathing space so we come down to here. The problem is, if I go to the next candle, no, it's this one. It's moved closer. So the question now at this point becomes, do I then once again move it further away? Or do I just let it hit the stop loss, right? So let's say, for instance, I decide, I'll move it slightly further away. Then we go to our next bar and it hit. But let's say, for instance, I'd put it here, so it didn't hit. The question then becomes, how far do you move your stop loss? And how far can you expect this to go further down? Now, we can look at here as there's a support level, a pre-established support level at 14451, right? So say, for instance, we were going to say that this was going to be our breathing space to this level, right? That would kind of be a logical kind of place to look at a support level, because this is kind of a pre-established and pre-existing support level. So we move it to there. So now the bar has not only moved down, but it's actually, jumped quite a bit to down here. So now you're in a dilemma, right? You've already moved your stop loss quite a way. So you've already increased the amount that you've lost, right? Because, if we go via our strategy, we know that, we have a 1 to infinity risk to reward ratio. When we placed our trade and we placed our stop loss, we placed it in a position where it would only be 1%, right? Or the one of our ratio, right? So depending on how much you put on the trade, could have been 2% of your account, could have been 1% of your account, could have been less, right? So the moment we move our stop loss, we actually increase our risk on the trade, right? So even though we increase the risk on a trade, it's not inconceivable that if you're already in the trade, and you've already collected a certain amount of profit, that it could be a wise idea to move the stop loss to allow price to breathe just that bit and you would hope it would recover, so then you could continue on, the process of compounding and gaining more profits, right? Because there's nothing worse than price having a slight pullback, stopping you out, and then continuing on into the correct direction, right? Because all of that could have been absorbed, and then you continue on with the profits. But when you reach a situation like this, you've kind of put yourself in a position where you've already moved the stop loss, so you're already taking more risks, right? More risks than you really wanted to do. However, you've kind of you're opening up the opportunity in order for it to recover. But when you get to a situation like this now, how far are you willing to move your stop loss? And this is the question, right? Because in a situation like this, we don't know if this is a complete reversal of the market. We might go completely into a bull market. And if that's the case, you will move your stop loss until you blow your account, right? But if you stop it out here, then you will feel probably like you should have probably just let it stop out in the original pace, right? So this is kind of the dilemma. And in all honesty, there is no right answer. It's kind of really, about your risk appetite and, how much nerve you have and how much you want to manage your account like that, right? So in a situation like this, as Daniel said, if we review the stop loss, we move to the next one, bang, stopped out. So we could have been stopped out way up here, but instead of that, we've moved that and we've just increased our losses, right? So we've moved our stop loss maybe three times the size. So instead of losing, that 1 ratio, we've lost like 3. So 3 times what we would have, right? And that could have been quite a bit of profit that was eaten up. So one answer is to review the stop loss. The other answer is, as Neil said, is close your trade or ride out, right? So ride it out is kind of, what Daniel said, right? Ride it out. But I'm assuming you mean moving the stop loss when you say ride it out, right? The other thing is, as you said, close your trade. Now, closing your trade, if you're to close your trade immediately, if you were in profit, you would have banked some of that profit, right? So let's say, for instance, our entry was, let me draw this here. So let's say that this was our entry line at green, right? So imagine that this could have been our stop loss here at the 15557 level, right? If we would have kept our stop loss there and, closed the trade, as it was said, we would have banked the profit that's in between, here and here. So all of this profit here, we would have banked, right? But at the time, we didn't know if price was then going to, before it hit we didn't know that if price was going to turn around and then continue onto the upside, right? So if we'd have banked it here, we would have stopped ourselves out of the trade and missed the recovery of price, right? But on the other hand, if price did continue onto the downside, right, we would have banked in this profit here between this green line and this red line here. So we would have banked that profit and we would have, what you call it, I'm going to say cut your losses because it wouldn't be a loss, it'd be profit. So cut your profits or bank your profits might be a better way to say it. You would have banked your profits in between the entry and the stop loss, but you would have taken yourself out of the trade and not been able to get any more of the, continued profits that you already had. As I said, if price had have turned around and continued going, you would kind of be thinking, maybe I made the wrong decision because I've stopped myself out of the trade and I could have continued on with the profits. The other side of that is, you kept moving your stop loss and then you got to the point where you got to entry and then price went below entry. So at this point, you're now not only no longer having profits, you're actually losing money, right? So you're actually losing profit, not even losing profit, you're losing money, right? So these are the two dilemmas. Those are the two things that you can do. And there are risks and rewards to both of them, right? They're positive and negatives to both of them. So you guys are right. You can either stop yourself out of the trade, or you can move the stop loss, allow it to breathe, and then continue on into the right direction, right? So those are the two things, or the two options that you could have had. So over this most recent times, it was really a time of managing your trades. So I always speak about, the markets, the stock market being like, a surfer. A surfer has to ride the waves of the ocean, right? So when it's not time to surf, the surfer doesn't go out there and go against the wave, or if there are no waves, or if the waves are going in the wrong direction, he doesn't brute force his way to try and brute force his way through the ocean, right? He takes assessment of the ocean and does the best, and makes the best decisions contingent on the markets. Same with someone who does sailing. You got to adapt to the direction that the wind is blowing, right? And if there are any storms coming and things like that, you've got to adapt to, right? So it's the same for us. When the markets aren't performing in the way that we want to, we have to manage our trades and our positions accordingly. So that could mean, not placing any new trades. That could also mean, as we said, adjusting your stop loss, or that could also mean, closing your trades and protecting yourself, right? So because we're trading, you can never predict the future and you can never predict the market. The only thing you can control is your own actions and your own behavior, right? So it's something you've got to kind of be mindful of with the markets. We all want to make the most money, but at the same time, you don't want to take on too much risk, right? So over these past few weeks, we've been having to, make the decision on our own accounts whether we want to, as you said, review the stop loss, or if you want to close your trades, right? And that's on each person's individual risk appetite in what they would want to do for themselves, right? So, and another thing is as well, it also depends on how deep you are into some trades, right? So for me on this occasion, I didn't move. Well, I was deep enough into a trade that I didn't stop myself out and I didn't need to adjust my stop loss. So for me, I basically rode it out, as as Neil Smith said. Like, I rode it out, but that's because I had my trade had gone deep enough into profit that when it did pull back, it didn't threaten my stop loss and I didn't get stopped out. Now we're not at the end of that now. But we'll go in to see the markets a bit today that we have seen a bit more of a recovery, right? So I think in one of my trades, or I should say in my, in one of my trades yesterday that I checked, I think I was hovering around the zero. So I was hovering around entry. And then when I looked today, I had a smile on my face because that's how I knew the market was turning around, because it was not near that zero mark today. So, so for me, I mean, again, we're not out of the woods yet, so I don't want to speak too soon. I didn't want to jinx it, but we did see a bit of a turnaround today, which we will see when we go a bit more into the markets and the indexes today. So, so it's one of those things where you have to kind of work with the markets and also be strategic in how you manage your trades. And again, there is no right answer. It's up to you and your personal kind of risk appetite in what you want to do with your trades. But let's clear these away and let's take a look at where we're at. So this is the US 100 index, right? The NASDAQ. So if we take a bit of a review, as we said, so we've been stuck in this consolidation from around the 29th of October or so. And we didn't really notice it was a consolidation till we got the pullback on the 22nd of November. And then it pulled back here on the 3rd of December. So this kind of established our kind of consolidation. And again, we pulled up and pulled back like our double bottom and then rose up. And then, Price was good up until the 27th of December, which is Christmas, the Christmas era. We had kind of a sideways movement over Christmas, as we'd expect. The markets would be quite, well, it depends. Sometimes the markets are a bit prosperous, but there's a lot of reduction in momentum. A lot of people are on holiday. A lot of people are, they're not at their desk, they're not placing trades and things like that, especially the big institutions, right? A lot of these big investors and institutions, they're off in the Aspen in the mountains and whatever, going on their, winter holidays and whatever you want to call it, their winter vacations over that time. So you can see in the market, there was quite a bit of, as expected, sideways movement, stagnation, doji candles that not have very strong bars, small wicks and things like that. And then we got to the beginning of the year, 3rd of January. And then from the 3rd of January, we see like the market did tank down quite a bit. I mean, coming to this level is not so bad because I said this is like our pre-established support level. And then we saw the tank before it pulled back, and then the market completely tanked, right? So again, since you want to say maybe the 4th of January, the beginning of the year, we've just been seeing the market going on a strict decline, right? But if we zoom out and look at the grand scale of things, where are we with the markets? It's a decline, but in comparison to the run, it's not like we're somewhere all the way down here or so forth. So it is quite a dip, but it's a mini dip. So we was previously at this level June 2021. So like 18 months. So we went back to 18 months low. So excuse me. So kind of like the 18 months of growth that we've had, we've kind of pulled back to that level. If we go back in and zoom in again, if we look at these bars, we can see that price went all the way down to this 13716 level, right? But then you can see how the market actually rejected that price, right? So even though we went down as far as that today, we can see that price quite a long wick, a very long wick. We can see that, so that the market was not happy at the markets being at that price. So we did see quite a sharp turnaround from that price level, right? So it came all the way back up to this 14163 level. So hopefully that's a sign that the market is starting to recover and turn around. Now, personally, I would expect price to come back to our resistance level, right? So I would expect to see price turn around and come back here. So I spoke about this previously about risk appetite. Now, it's up to you how much risk you want to take, right? So price as it is not in an ideal position, right? We always like to see price trading at all-time highs or at least above our resistance level, right? However, there is a strategy in trading. We do breakout strategy, but there is also a strategy called a pullback strategy, right? Which is where you enter the market on a pullback, So some of you who may have a higher risk appetite may decide that actually you want to enter the market down here and then take advantage of all of this profit that could be made here, right? Between current price and our all-time highs, right? So, evidence may suggest that we're in a bull market and, this is a slight pullback, and in a bull market, we will see price return back to, its high and pre-established level, right? It's hit this level twice already. And, there may be a school of thought that might say, we would, in a bull market, we expect pullbacks and then we expect price to continue on in the same direction. So there may be a school of thought that may say we would enter here on the pullback and then ride the profit all the way back to our current high level, or which is our all-time high level as well, right? So that is one school of thought. So for those who may want to be a bit more risk-taking, live life on the wild side, live in la vida loca. If that's you, you may want to enter into this level here. For some others of you, you might want to see a bit more recovery of price. So maybe you would like to see price, recover a little bit, come maybe even halfway up there before you decide to go in. Or those of you who are, risk averse and maybe want to be more on the, capital preservation side of the game, you might want to wait till price breaks and closes above this level. Maybe has a little pullback to establish that it's not a fake out and indeed is a breakout. And then we see, this level of resistance actually hold as a level of support. And then we see price continue to the upside, right? So that might be what you might want to do. So again, there's different levels of risk. There's getting in on a complete pullback. There's getting in on a part or a semi pullback. There's getting in when price actually reaches our resistance level. And then there's getting in when after price has retested that resistance level and continued on to the upside. So, it's something that you might want to think about in terms of your risk appetite. Again, this goes back to trade management, what you want to do with your trades and how you want to manage your trades, right? So, so this is basically what we've been seeing on the NASDAQ. Let's take a look at our other indices. Let's go to the Dow Jones. Let's see what the Dow Jones has been looking like. So again, quite a similar story, but quite differently actually. So if we look at the daily time frame on the Dow Jones, we can see we reached our all-time highs on the 4th of January. If we go here, let me change this to red again. If we go here, we can see that this is our current, resistance level, our current high. And then since that time, prices just dwindled across all markets and indices, really. Price dwindled down to, here on the 11th of January, excuse me. We saw a slight pullback onto the 13th of January, and then we saw price tank. But here we saw price, tank to our pre-established, support levels. We can see if we go back in time, a few times it's kind of, being quite irrelevant in the Dow Jones. We've seen it break through here, but we could see a bit of resistance here before it broke through. Again, here, it held a few times here and here. So we can see that because this is kind of being this 33996 level historically has been quite a strong resistance level. We can see that even on days where we have these massive candlesticks, look at the size of these candlesticks, especially on the 24th of January, we see a massive candlestick drop, but price always closed above that level. Even on our following day, 25th, 26th, 27th, and 28th, even though the wicks broke through, we can see by the bar that price always closed above this level. So in this index, we can see that that's quite a strong level for this market. Price generally doesn't like to go below that level. We've seen it here that price didn't go below that level on the candlesticks, slightly here, but majority of them kind of closed above it, right? So we can see that in this market that this 33996 level is quite strong in this index. So we can see that, as opposed to what we just saw on the NASDAQ where price completely just tanked and fell through it, here it's kind of held better. It's held better on this indice. And then we saw a quicker recovery. Look at from the 28th of January, we saw an early recovery. We didn't wait till today or yesterday for the recovery. We saw a recovery, again, a slight pullback here, and then we've kind of recovered as is back to our most recent high point here. And again, similar story. Ideally, we'd like to see price go right back up to our resistance level or our current all-time highs. And this indice has much more indication or much more of a view that price is likely to do that, right? We can see that it's already started to recover and it's done its pullback, and then from its pullback, it hasn't completely, tanked to the downside. It actually, pulled back and continued back onto the upside. And we can see that price is currently at a level higher than our most recent high. So our most recent high was here at the 35680 level, and price is currently at this 35768 level. So we're actually slightly higher than this most recent high. So we're having higher highs at the moment, and this is a higher low than our previous low. So we're having higher highs and higher lows. So this would indicate that price again is trying to go back to the upside. We've broken close above this most recent high. So it's again all indications that our price is going to recover to the upside. So again, we're seeing some recovery to the markets, and similar statement applies here. Whether you want to be a bit more risk averse or you want to wait till we're trading back at all-time highs, you can apply that similar logic to this market. Okay, let's go to our next market. Let's look at the SPX, or the S&P 500 index. Again, this is a similar story to the Dow Jones. In fact, the market looks basically the same, right? If we zoom out a bit and we highlight our common support and resistance level, similar story. Price tanked from the 5th of January, tanked, pullback, tanked, long wicks, no bar closing below this level. We saw a pullback to the upside. Again, it pulled back down, and then again we've seen a bit of recovery. The only difference is here on this market, we can see that we haven't actually broken our most recent high. So if I was to draw the line, our most recent high, which is here, I don't know, the line might be a bit thick, but you can see it. So you can see there's actually a gap between the line and this bar, whereas there's no gap between the line and this bar here, which is illustrating that price hasn't completely usurped our most recent high. So we're making higher lows, but we're not actually making higher highs at this point. But again, if we were to draw our resistance level on here, I would fully expect price in this index to continue on to the upside, and then continue to our resistance level, and then break through. If we zoom out a bit, we can see that the market has continued to be quite bullish since all time, really. So we can see we're on a run that's been continuing since March 2020. We had the COVID pullback. It was a bit sideways, and we had the COVID pullback, and then the recovery from COVID has actually been very good. A great run we've been on since March 2020 with this index all the way. We've seen a minor pullback. Now, if you compare that pullback or that dip to this, this is minuscule or insignificant, right? Obviously, it's significant to a level, but if we're looking at the full, range of how far this dipped in COVID, this is not really much. Let's take our ruler. So the dip in COVID was, it's around, I can't really see it because I didn't make enough space. Well, we can see minus 31.32%. So basically a third, really. Then if we were to go here and then measure this one, this is like 11%, right? So it's not even close. The other one is like, what, 3 times? The COVID dip is about 3 times this dip. So although this dip is significant, it's not as significant as we've seen in this market, and we've seen a recovery, right? So, there was no suggestion to me that this is, the top of the market and we're going to a bear market. It was just, quite an exaggerated pullback. But nothing too serious. Again, if we've gone through COVID and recovered, I would expect a recovery from this. And again, we're not out of the woods yet. It hasn't completely recovered and hit our most recent high and continue to the upside. But I would expect it to do that, go back to that level and continue to the all-time highs. All right, let's go to another index and see how that's performing. Let me make sure I'm up to date. Yeah. If we go to the UK 100 index, and now we can see quite a different story here, right? So let me see the chat. What do we notice that's different about the UK index as opposed to the American indices that we've been looking at previously? What do you guys see as a difference with this market compared to the other markets? So Daniel says price is maintaining its high level. What say you, Neil? The UK market is recovering faster. Right. So both of you are correct. Yes. So if we zoom in a bit more and take a look at the recent times, but also notice that, you know, the angle in more recent times has been a lot more flatter. So we haven't, you know, had a raging, you know, upwards movement. It's been more of a slight incline, right? So, you know, if we see a massive growth and we had a dip, you know, the ratio between the dip and the incline is different to the flattening, right? So if you dip from here, the comeback would kind of maybe only be part way. Whereas if you're on a more of a flatter level, if you dip the same distance, the recovery is a lot shorter because we're not moving up as quick, right? So having said that, we can see that price was, let me zoom in a bit. I don't want to distort it too much. There you go. So we can see that price, you know, was moving quite bullish. We got to 17th of January. So, you know, a lot of the other markets dipped way early. A lot of them we were seeing, you know, the 5th, we saw the dip in a lot of those other markets, 4th and 5th. So here we saw actually more bullish momentum after the 5th, right? So the 5th is, where's the 5th? Let's find the 5th. So the 5th is here, right? So even after the 5th, we still had bullish momentum, right? Whereas the other markets on the 5th was like the last day and we saw complete tanks to the downside, right? So in this market, you know, it didn't act the same as the other indices, right? We still saw bullish momentum. We got to the 17th of January and then we started to see a bit of sideways momentum. Sideways momentum on the 17th. And then it's not until the 21st of January is where we actually saw our downside dip, right? But again, it was only a brief dip. If you look at, you know, here, it was a dip of 2 days. It was the 21st of January and the 24th of January, right? So it was basically over one weekend, one Friday and one Monday, right? That's when we saw it. And then we immediately saw a recovery. So since then, you know, price has been to the upside. Yeah, we did get a few, you know, parallel days, parallel bar days, even here again. So we had them on the 27th and 28th, and then again on the 2nd and the 3rd. But price recovered quite quickly, so much so that we actually have you know, an all-time high and a breakout indicator on the market. Now, obviously, we don't trade indices, but just to illustrate the upward momentum and the recovery that we've had. So if I were to draw the line, you know, of where our most previous high was, you know, we're actually trading above that high again, and we're actually trading at all-time highs. So, you know, if you had a UK stock, you know, you would definitely be seeing, you know, price recover higher than it was previously before the dips, right? So you're definitely looking at a bit of recovery from UK stocks. So again, so, you know, if you're dealing with, you know, risk reward on this instance, there is no really well, there's minor risk to be had, right? So again, we're although we're above our all-time highs, we're not, you know, quay above. We're only just above, right? So we could see that as a fake out and price pull back down. I don't think that's likely, you know. Again, we can never really predict the markets, but I wouldn't expect that to happen, right? I would expect price to continue on to the upside and continue in a bullish direction, you know, and whilst doing that, take along all of these UK stocks that are on the UK 100 index, right? So that is what my expectation is for this market. We continue to see good recovery to the upside of these markets. Let's take a look at our last indice, which is the US dollar index futures. So again, another different looking chart. Let me reset it so we can see it again. So again, we've seen, you know, good momentum to the upside, kind of somewhere in between, you know, the UK and the previous US ones that we were looking at. And then after that, we saw quite a bit of sideways movement. It's slightly actually bearish, but it's sideways, you know. So, you know, we could see already that this market, you know, it wasn't necessarily making lower lows, but it was making lower highs, right? So our kind of most recent, you know, support level is here. Although we pulled back to this level, we never really pulled back to it again. Even here came close, but we kind of recovered. So we're kind of going into what they would call a what do we call it? Like it's like a convergent trend line, right? So, you know, in some trading, you would have, trend line, there we go. So in some, you know, thoughts of trading, if we take the highest point, we can see that it's following a certain pattern, right? You can see how if we draw this line, price is hitting these trend lines again. So we draw it from there to there. We can see that, you know, price pulled back, pulled up to there, pulled down to our support level, pull back up to this level, and you can see prices continue to hit this trend line, this kind of narrowing trend line, going slightly. This is started from, you know, the 24th of November. So this is something that's been happening, and then, you know, it was looking to converge around this kind of point here, which would have been, you know, 8th of March or so forth. But again, we saw quite a big dip in price on the 12th of January, right? Let's zoom in a little bit more. So we can see on the 12th of January, price dipped quite severely here. So again, we saw 2 days. We saw this 12th and 13th. So again, previous, like we saw the UK on the UK index at different times, but very similar kind of status. 2 days of quite drastic dippage, and then we see a recovery almost instantly. And then we've actually made all-time highs, you know, above our 24th of November level. We actually reached our all-time highs here on the 28th of January. So we saw quite a rapid recovery. Not only a rapid recovery, we saw quite a, you know, an excelling above our most recent high to this level. But then since then, you can see that, you know, whatever it was that was the market was suffering from, it's still affecting it, because, you know, maybe the market, you know, took profit, or whoever was in whatever position at this point, which wildly swung the market. But then we saw it again wildly swing back in the other direction, right? And price again tried to break and close below our support level, but this time it held quite a bit. Right, we can see that price didn't really move too much past our support levels, right? So we're seeing price, you know, hovering around the support level. So it's gone for a wild dip and a wild spike, and then it dipped again, and then price is not really sure what it wants to do. The market doesn't know what it wants to do, so it's kind of hovering around this support level, right? So at this point, we can see multiple things that could happen, right? There's quite a bit of indecision in this indice. We can see price again break down to our previous support level, or our previous low, I should say, that established support level. We can see price go down further, maybe to this established support level around here. All right, so we can see price break down even further. We can see price continue to consolidate in a straight line, or we can see price, go back to our most recent high level, right? There is another option, as again, because we can see this trend line is trying to zero down to this point here. We could just see, price continue to consolidate into our little, our little narrowing trend. We can see it go to here and then go to here. And then as I've broken down before previously with these kind of narrowing trend lines, when it gets to this point here, it usually has a wild reaction, right? So we know that price moves in straight lines, then it consolidates, then it moves. I mean, it doesn't move in straight line. It moves, in a direction and then consolidates, moves and consolidates, right? But we know this consolidation, the longer the consolidation, the wilder the breakout, right? So what usually happens in here, it's like a spring, right? So imagine it's winding price tighter and tighter and tighter and tighter. It's moving tighter and tighter. As it gets to this point here, it usually breaks out quite wildly. It has a direction. It's either going to break out wildly to the downside or it's going to break out wildly to the upside, right? So again, this is not real. I mean, because we're in a bullish market, I would expect movement to the upside. Also, we have a pre-established, high levels here and here. So we already have pre-established high levels, and the trend is very bullish, even though the current bias has been a bit bearish. But even in this instance, it hasn't even really been too bearish. It's been more, if I get rid of these lines here, again, it's been more of a kind of a sideways consolidation, right? It's kind of been more of that than a strictly downward, like a severe downward motion, right? It's been more of a kind of a sideways consolidation. Yeah, it broke out of a little consolidation to the downside. It faked out here. Again, it broke out a little consolidation to the upside. It faked out here. So, we may be also seeing, a continuation of the consolidation in this trench or in this channel, right? This might be a continued consolidation, and we might then again see price for quite a while moving in this sideways direction, right? So, with this index, it's not really clear as to what price will do. We don't have like a proper setup shape, setting up, a specific direction of price in which way it's going to go. So there's not really, if we're talking about, taking a risk on position or gambling whether it will go up or whether it will go down or things like that, because this doesn't really have a such a clear shape to predict kind of the direction of it. It's not as easy to predict this index compared to the other ones. Other ones had like better setups of more clearer pullbacks, more sharper pullbacks or sharper recoveries, whereas this has pulled back, it has recovered and it's pulled back again. So, it's not even like you can say this is like a pullback strategy that when price gets to here, you can kind of continue, because this is not really a pullback. This is kind of a continued consolidation since, we entered this channel on the 15th of November. It's just a consolidation. It just broke out of the consolidation channel more recently. So it's not a clear pullback of price to then recover. Again, we might see just more sideways movement. So it's not necessarily that you want to take more risk and enter here on the pullback foot to recover, because it's not really that situation. It's not like you might say, halfway on the recovery, because again, it's just the middle of this consolidation channel. And again, you wouldn't want to say when price actually hits this level, again, because it's still part of the consolidation channel. And furthermore, you wouldn't even want to say when price breaks, right? Because price is already broken here, and it was a fake out. So this is an example of why I usually say, for the safest opportunity, you want to see price break, you want to see it retest this resistance level and turn this resistance level into a support level. See, this is what it didn't do here. It broke here, it broke the resistance, but when it came to retest it, it failed the retest and actually broke through. So ideally, for something like this, we would like to see it retest the resistance level, it turn the resistance level into a support level and hold at that level, and then continue to come onto the upside. So once it breaks, you know, our most recent high levels, which will be here, once it breaks these levels, you know, we can see that that's kind of established itself as a decent resistance level that can act as a support level. You know, we've seen it act as a resistance level here and act as a resistance level here. So, you know, we will kind of be able to have a bit more faith that, you know, if we've broken through this level, you know, it created it the first time, the second time it created it, and then we broke through on the third time. Like, this is more of an indication that this resistance level might hold better as a support level, right? So that would be kind of something that if you would kind of want to be more on the safe side with this indice, that's the type of thing that you'd be looking at, you know, to be sure before you start going back into the market and going back into the trades. So so that's basically the current state of the markets. If you're on the master investor tier, you would have seen I've posted, you know, 2 premium trades today. So it's trades that you can take, but those trades are, you know, on the riskier side. As I've said in the notes, if you read the notes on the premium trade, you know, those trades are on the riskier side. You know, if you want to be, you know, certain, then you would wait for, you know, price to recover back to its all-time highs again, or the indices to recover back to its all-time highs. But again, you know, it's the risk reward ratio. The more risk you take, the more reward you will get. But again, it's more risk, right? So it's for those of you in the master investor tier, you might want to start taking those trades. And then, as we spoke about previously, you know, play the pullback strategy where we ride, you know, the indices back to its all-time high levels and then capture that, you know, that little extra bit of profit from price where it currently is to its you know, parity level or its all-time high level. Or if you want to be more on the safe side, you would wait for, you know, those premium trades once we start hitting all-time highs. Again, there is no right answer, there is no wrong answer. It's just your risk appetite and how aggressively you want to attack these markets. You know, if you really want to you know, try and squeeze every penny out of the market, then you might go a bit more of a riskier strategy. If you want to go more of a capital preservation angle, then you might want to wait till we're hitting all-time highs.